London, April 2026. A macro research desk publishes a note with a confident assertion: the consensus is always fully priced in. It is the kind of phrase that sounds unassailable until the data disagrees. 3 days after that note circulated, a contract tracking the probability of a Federal Reserve rate cut repriced by 22 percentage points in a single trading session. Treasury yields moved. The FOMC commentary shifted. CPI data was revised upward. And yet, the Polymarket risk-reward scatter had already identified that contract as undervalued, sitting quietly in the upper left quadrant, waiting for the market to catch up. That is what this tutorial is about, not the consensus, but the gap between the consensus and the evidence. Welcome. Before we reach the scatter, we need to establish first principles. A prediction market is a financial contract that resolves at $1 if a specific event occurs, and at 0 if it does not. The price at any moment, expressed in cents, from 0 to 100, reflects the collective probability estimate of everyone actively buying and selling that contract. At 60 cents, the market is saying, 60% probability this event happens. That is the mechanism. The reason macro investors, central bank watchers, and geopolitics analysts pay attention to these markets is that they aggregate information faster than surveys, faster than official forecasts, and sometimes faster than the institutions themselves. The Fed may signal patience. The prediction market may disagree. That disagreement is the signal this tool is designed to find. If prediction markets are meant to aggregate information efficiently, why do mispricings exist at all? 3 reasons. First, attention asymmetry. A ceasefire announcement or a surprise NATO communique lands on a Friday afternoon. Most institutional participants are not watching the specific contracts tied to that event, and the market drifts for hours before it corrects. Second, liquidity gaps. A contract covering a niche OPEC output question, or a BRICS currency arrangement, can sit well below fair value because insufficient capital is flowing through it to push the price toward consensus. Third, information lag. A central bank forecast, fresh CPI data, or a new sanctions designation hits participants in one geography before others. In each case, there is a window, a period when the price and the evidence diverge. The scatter is designed to find that window systematically. The risk-reward scatter on Polymarket plots every active prediction market contract as a single dot on a 2-dimensional grid. The horizontal axis X measures potential reward. Specifically, it shows how far the current market price sits from what the algorithm estimates as fair value. A contract priced at 40 cents, assessed at 60 cents fair value, sits far to the right on the x-axis. That is a large potential reward. The vertical axis, y, measures risk. It combines 2 inputs, liquidity depth, which tells you how much capital you can deploy without moving the price against yourself, and time to resolution, which tells you how long your capital is committed before the contract settles. A contract resolving in 2 weeks with deep liquidity sits low on the y-axis, that is low risk. Together, these 2 axes map every active macro and geopolitics contract onto a single visual field. Let us spend a moment on the x-axis alone. The further a dot sits to the right, the larger the gap between what the market is currently pricing and what the Polymarket trade signal model estimates the contract is worth. That fair value estimate is not arbitrary. It is derived from volume-weighted signal aggregation, drawing on the activity of large position participants, who tend to carry informational edges in their respective domains. Think of it as the institutional estimate, separated from the retail noise. When you see a contract sitting far to the right, say, a Fed rate prediction contract where the market price is a 30% probability but the signal model estimates 50%, that is a 20-point differential. In macro forecasting terms, 20 points between market price and informed estimate is a material opportunity. The scatter surfaces these in seconds rather than hours of manual research. The y-axis is where discipline lives. A contract can show a remarkable potential reward on the x-axis and yet sit dangerously high on the y because the liquidity is thin, or because the resolution date is 18 months away. Consider a war probability contract tied to a specific geopolitical conflict. If it resolves only when an official ceasefire is formally declared, and there is no credible timetable, your capital is committed through multiple FOMC decisions, multiple CPI prints, multiple ECB and BOJ policy shifts, and multiple turns in the broader macro environment. That is significant exposure. Low on the y-axis means the opposite: ample liquidity so you can exit if new evidence arrives, and a resolution timeline measured in days or weeks rather than quarters. The combination of high X and low Y is the target. That combination defines the upper left quadrant. Now we place both axes together. The upper left quadrant, high reward on X, low risk on Y, is where analytical attention should concentrate. Contracts in this zone are statistically undervalued relative to their risk profile. They offer the greatest potential return per unit of capital at risk. On Polymarket the scatter lets you filter by category. You can isolate Fed rate prediction contracts. You can isolate geopolitics prediction markets tied to NATO decisions, sanctions regimes, or OPEC output agreements. You can filter for BRICS developments or emerging market central bank forecasting signals. Each filter redraws the scatter with only the relevant contracts visible, so the opportunity zone becomes immediately legible. The analytical noise disappears. The signal remains. This is the core proposition of the tool. Make the research process faster without removing the rigor. There is still substantive work to do once you identify the dot. Let me make this concrete. Last week, a contract tracking the probability that the Federal Reserve would hold the Fed funds target rate unchanged through June appeared on the scatter at 34 cents. The fair value estimate from the Polymarket signal model was 58 cents, a 24-point gap. On the y-axis, the contract showed strong liquidity depth and an 18-day resolution window. It sat firmly in the upper left quadrant. The macro context supported the signal. FOMC minutes had been more hawkish than the market had fully absorbed, CPI data was printing above the ECB-aligned consensus, and Treasury yields were already beginning to reprice the short end of the curve. The scatter flagged the gap before those dynamics became consensus. Within 4 trading days, the contract moved from 34 cents to 51 cents, a 17-point repricing. That is the tool operating as designed. Once you have identified a contract in the opportunity zone, the next step is the drill down. Click any dot on the scatter and the market detail panel opens. You will see the full resolution criteria, exactly what event must occur for the contract to settle at $1. Read these carefully. Resolution criteria are the foundation of every position. You will then see the liquidity depth chart, which shows how much capital is available at each price level and whether you can deploy your intended size without moving the market against yourself. You will also see the historical price chart, which tells you whether the current price represents a trend or an isolated anomaly. If the evidence holds, criteria are clear, liquidity is adequate, the time horizon fits your macro view, you connect a wallet, enter a position size, and confirm. The full process, from opening the scatter to confirming a position in an undervalued geopolitics or central bank forecast contract, takes under 3 minutes by design. Let us close with the essential framework. The risk-reward scatter on PolymarketTrade translates the entire prediction market universe: Fed rate prediction, geopolitics prediction markets, central bank forecasts, inflation probability, war probability contracts into a single structured visual map. High reward, low risk, upper left. That is where every research session should begin. Filter by the macro categories that match your analytical focus. Identify the gap between current price and fair value. Check the y-axis before committing capital. And always read the resolution criteria in full. If you found this framework useful, subscribe for the next episode in this series, which will cover category filtering in depth and the process of building a watchlist of high-conviction macro and geopolitics contracts. The scatter link and the Telegram Signals channel are referenced in the description. Thank you for watching.